In an age obsessed with hockey stick stock charts and crypto speculation, value investors operate in an underground movement. While the mainstream chasing moonshots and momentum stock, they contend chaos like sacred texts, whispering incantations like discounted cash flow and owner earnings. They do not care for hype cycles or visionary CEOs promising to disrupt everything from taxis to AI. They care about price and value. That's it. Their tools are simple: a calculator, a clean spreadsheet, and a bunch of books. Their creed? Patience, discipline, independent thought. While others livestream options trades from Tesla, these investors quietly wait for mispricing for fear. When panic hits, they will start screening for cheap stock. To outsiders, they seem like relics from another time, slow, overly cautious, stubborn. But to those who understand, they're playing a different game. Not the game of what's the next quarter result looks like, or look at the new stock Druckenmiller just brought. They hunt in the shadows of the market, looking for forgotten businesses, decent balance sheets, and opportunities hiding behind bad headlines. They don't just look for what's hot. They ask, what's real? What's durable? What will still be earning money when the bubble pops, the crowd vanishes, and the market sobers? While the world flocks to what's new and noisy, the value investor retreats into silence, content with underperformance in the short term, knowing that compounding doesn't make headlines, but it makes fortunes. And of course, something strange is happening in the value investor sphere. Before COVID, value investing was almost a monastic discipline, quiet, contrarian, borderline boring. The practitioners were rational to a fault, allergic to hype, and obsessed with balance sheets, free cash flow, and long-term moats. They didn't chase trends. They didn't join Twitter threads with rocket emojis. They weren't cool, and they didn't care. But now, the market's showing cracks. Speculation isn't working like it used to. And suddenly, everyone's a value investor. Crypto bros who once bragged about flipping NFTs at 10x are now deeply focused on fundamentals. Growth bros who mocked boomer stocks are rediscovering the joys of free cash flow. Twitter Spaces, once filled with moon talk and meme coins, now echo with words like margin of safety and DCF model. Even some of the loudest gamblers have rebranded, claiming they were value investing all along, just in future assets. It's like watching a spiritual revival, except the converts are wearing Supreme hoodies and quoting Warren Buffett. What was once a niche of patience and humility is now being invaded by rebranded speculators looking for shelter in the storm. Before COVID, value investing was a quiet, disciplined craft practiced by a certain breed of investor. These were the people who genuinely enjoyed reading financials on a Friday night. They listened to earnings calls while folding laundry, got excited about margin expansion. To them, volatility was just the emotional outburst of a moody marketplace, not a call to action. Their investing checklists were strict. They looked for evidence of insider buying and catalyst. These were the disciples of Benjamin Graham and Warren Buffett, not fans of YouTubers who say smash that like button before recommending penny stocks. But then came COVID, and everything broke. The world shut down, the markets crashed, and the Federal Reserve printed money. Suddenly, airline stocks were down 80%. Dogecoin was up 800%. And Dave Portnoy declared himself a better investor than Buffett. For a moment, value investing looked like a relic of the past, something your grandpa did between checking bond yields and yelling at the TV. But it didn't die. No, it mutated. Rising from the ashes was a new kind of creature, the post-COVID high-quality tech growth value investor. This wasn't your old-school cigar butt picker. This was someone who used all the same language: margin of safety, intrinsic value, moat. But now they were applying it to NVIDIA, Palantir, and occasionally Tesla. They still run DCFs, yes, but now the future cash flows assumed a global AI takeover by 2027 and ChatGPT replacing the entire workforce. But wait, it gets better. Lurking in the background, dusting off their Binance logins and old ledger wallets, we got our reformed crypto brothers. These were the guys who once believed in decentralized finance, then lost everything on Luna, and then somehow lost more. But now they're different. They've traded in their hoodies for collar shirts and start sentences with, according to my model, this can 10x. I only buy high-quality compounders like Tesla, Nvidia, and Dogecoin again, but this time with a thesis. Their portfolios are, let's call it imaginative, heavily concentrated in Nvidia and Tesla, lightly sprinkled with Palantir, and emotionally dependent on watching Cathie Wood explain how AI will usher in utopia. They run DCF models, absolutely. The only problem? They make up half the inputs. Assumptions include AI becoming sentient, global GPU shortages being solved by 3D printing silicon in space, and your grandma launching an Ethereum validator node in her backyard. Eventually, the line between investing and storytelling vanished altogether. These folks aren't just investing anymore. They're playing fantasy finance. They quote Buffett in the morning, run Monte Carlo simulations by lunch, and buy Palantir after dinner based on a single tweet that said, "This company is the next Google." One day, they'll argue a $300 billion company has huge upside if it captures 80% of the entire AGI market. The next day, they'll assure you that their DCF shows a 70% margin of safety. If, of course, you assume interest rates go back to zero, and we all agree to ignore reality. And online, Reddit has become a full-blown satire of itself. You'll find top comments like, Tesla isn't just a car company. It's a software company, an AI company, an energy company, a movement, a lifestyle, a religion company, and people nod along with conviction. So here we are. Once upon a time, value investors were known for patience, skepticism, and a healthy fear of hype. Now, everyone's a value investor, as long as value includes unlimited faith in AI, optional understanding of financial statements, and a DCF that requires belief in miracles. The market may be topping out, a recession may be on the horizon, but hope springs eternal, especially if it's wrapped in exponential charts and a new bull case from ARK Invest. And then, there's you, sitting there watching all these so-called value investors on YouTube. The ones with LED lights in the background, dramatic thumbnails like, "This stock a 10x?" and titles that start with, "Warren Buffett would love this." They've got no accounting degree, but they do have a whiteboard, a Patagonia vest, and a deeply concerning obsession with discounted cash flow models built in Excel with zero actual numbers. You watch them break down stocks with confidence like, "This company loses money now, but if AI cures death, it's actually undervalued." And you sit there thinking, I could do that too. Next thing you know, you've downloaded one DCF template, changed two assumptions, and you're calling yourself a value investor on your Instagram bio. You've never read a 10K, but you've definitely watched 3 hours of someone explaining why Palantir is the AWS of data, while holding a mug that says compounder mindset. It's okay. We've all been there. Just maybe don't remortgage the house because some guy named FinVestman420 said Nvidia is going to $10 trillion based on his DCF analysis. Most people really, truly, absolutely should not be picking stocks. If you can't explain what free cash flow is without reaching for your phone mid-sentence, while you're literally talking about investing, then maybe, just maybe, you're not ready to build a portfolio based on vibes, Reddit karma, and the latest tweet from someone named iInvestor69. Investing isn't supposed to feel like trying to pick a favorite child during a thunderstorm while blindfolded. And yet, here we are, staring at phone at 2 a.m., sweating bullets because their favorite undervalued growth stock is down 6% after earnings missed by a penny. They've read 14 Twitter threads, watched 3 YouTube videos titled "Why the Market is Wrong," and are now questioning all their life choices. All because they all went into a company they felt good about but couldn't pronounce the CFO's name, let alone explain the business model. Here's a wild idea. Just buy a low-cost index fund. Own the whole market. Let the S&P do the heavy lifting while you sleep like Warren Buffett after a large Dairy Queen sundae, dreaming about moats and See's candies, not whether your call options expire worthless tomorrow. And let's not forget, the new seductress on the block, bonds. Yes, bonds. once considered the financial equivalent of khaki pants. Now, they're quietly strutting back onto the scene, offering 5% risk-free yield. That's right, you can earn a solid return without watching your portfolio swing like a crypto chart on Fed meeting day. Bonds are kind of hot now, so unless you're putting in the time to actually understand financials, analyze businesses, and not just copy whatever's trending on FinTalk, it might be time to stop pretending that you're the next Peter Lynch. On the index, buy some treasuries. Embrace the boring, because sometimes the best strategy is not losing sleep over stocks. So, are value investors still out there? Or did they all get swept away in the great tsunami of AI hype, zero interest rate euphoria, and YouTubers screaming about once-in-a-lifetime buying opportunities every Tuesday? Well, Reddit's value investors aren't extinct. They're just harder to spot these days. Buried beneath mountains of acronyms, AI hopium, and a 78-tab Excel sheet where half the cells say TBD or trust me, bro. They still use the sacred phrases intrinsic value, margin of safety, long-term horizon. But now those words mean things like, I've bought NVIDIA at $1,100 instead of $1,200. I'm disciplined. We've entered a weird new world where being a value investor means holding tech megacaps, quoting Buffett, and ignoring that none of this remotely resembles what Buffett actually did. It's cosplay, Buffett in the streets, Cathie Wood in the spreadsheets. So next time someone tells you they're a value investor, just ask them one thing. Do you own that AI stock because it's undervalued or because you're coping? Let's be honest. This market feels like a casino in a business suit. And while everyone loves to pretend they've found a next 10 bagger, most are just pulling the slot machine lever and praying it lands on innovation. So here's your friendly reminder. The stock market is not a video game. It's not supposed to feel like gambling, and if it does, you might be doing it wrong. You don't need to be a genius or decode quarterly earnings while eating cereal at 3 a.m. For most people, boring works. Diversify, invest consistently, avoid hype, and you'll probably beat 90% of those high-conviction stock pickers shouting into their webcams. Invest wisely, sleep peacefully, and remember, no amount of AI can save a portfolio built on hopium. With that, this is Visionomics, signing out.